Are you thinking about whether to invest this year or not? Due to the impending financial crisis, many people are staying put. Lots of investors are scared that the market will crash and that they'll lose their money in the long run. Amidst this crisis, Warren Buffett actually says otherwise. In this video, you will learn how you should invest this year, especially in light of the crisis that investors are facing. What do billionaires like Warren Buffett do during these times? Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the essential details that can help you keep yourself up to date about finances, wealth, and investments, then make sure to watch until the very end. When looking at people who panic sell during times markets are down, Warren Buffett made a remark. Some people should not own stocks at all because they just get too upset with the price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. The fact that emotions lead lots of people to do things they might regret in the future regarding their investments doesn't really come as a surprise. You must know by now that there exists a chart about market cycles involving the emotions of people. Every investor always tells to buy low and sell high, but still buys high and sells low in the end due to emotional interferences or any other circumstances that influence their decision. The majority of individuals don't seem to have specific investment objectives, and they frequently lack dedication to the long-term goal. Basically, it is a poor idea to flee the temporary turmoil as soon as things turn sour and a recession strikes rather than seizing the chance. Making a fortune isn't easy, but the profits to be earned are great if you know how to play the right cards at the right time. Warren Buffett made additional statements regarding this behavior. We're a net buyer of stocks over time, and who wouldn't rather buy, a lower price? At a higher price, people are really strange. Most people are savers, and they should want the stock market to go down. They should want to buy the lower price, but they get the feeling that they just feel better when stocks are going up. Looking at this statement, people like Warren Buffett think the opposite. He cannot understand why people don't want to put money in when the markets are down. They, after all, insist on wanting to buy at a lower price, yet only invest when the price is getting higher. For billionaires like him, a recession presents an opportunity to buy a stock at a really low price. As Warren Buffett said, fearful when others are greedy, greedy when others are fearful. Now let us examine the historical bull and bear markets in the United States since 1926. It is clear that the US has experienced 11 bear markets and 15 recessions since 1926. If we include the pandemic crash in 2020, there will be 12 bear markets. Bear markets lasted 14.7 years on average, whereas bull markets persisted for 75.4 years. It is a truth that if you made investments during these dreadful times, you would have gotten good returns. Investors who made investments during the largest bear markets in recent years had gains of 20 to 50% within a year. Although there isn't an ideal market in which to invest, these patterns demonstrate that these bear markets do present excellent possibilities. For instance, you would have earned 9% on your investments if you had made them at the high right before the pandemic. However, if you had bought several days after the high during the market's downturn, you would have already gained 60%. This means that returns are really huge for those who are willing to invest during a market downtrend. It is much more than timing the market and investing only when it's going high. This, after all, makes an exchange with the risk you're willing to take. Risking an investment during a downtrend really is much higher than literally seeing it gradually go up. Now, if you're thinking if you should enter the market now without making errors that might cost you a lot, there are actually two things you can do to maximize your opportunities. 1. Be informed about market developments so you can anticipate when these chances will arise. And 2. Whenever you see a market downturn, implement your approach appropriately, whether passively or actively. If you choose to do your investments for the long term, you may adopt dollar cost averaging. Dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a particular asset, regardless of the asset's price. The idea behind this strategy is that by investing a fixed amount at regular intervals, an investor can reduce the impact of volatility on the overall purchase. This can help to reduce the risk of buying at a high price and can result in a lower average cost per unit of the asset over time. Dollar cost averaging is pretty much a way to go for passive investors. Let's examine how active investors make sure they wouldn't fail while making investments in a volatile market. The first thing we need to understand is why businesses are currently suffering thanks to inflation and rising interest rates. This suggests increased prices, decreased consumer expenditure, and rising debt costs. The company you're considering must have a price advantage, which denotes that they have attained a competitive position and are able to raise prices without seeing a decline in sales. For instance, lots of products cut their prices just to make sales. On the other hand, if you look at food-centered businesses, they have the ability to increase their prices without losing buyers. Consumers obviously need food and will probably still buy their products even though their prices are higher. A company's business model is the way in which it generates revenue and profits, and it can reveal a lot about the company's competitive position and its ability to adapt to changes in the market. For example, a company with a strong and sustainable business model that has a competitive advantage, such as a strong brand, a loyal customer base, or a unique product or service, may be more likely to weather economic downturns and be more profitable in the long run. On the other hand, a company with a weak or outdated business model may struggle to generate profits and may be more susceptible to competition. Therefore, understanding a company's business model is crucial for assessing its potential for growth and profitability, and for making informed investment decisions. That is all for this video. As always, we at EM3 wish you the best of luck. We hope you enjoyed watching this video, and don't forget to give a thumbs up if you liked it. Please subscribe if you haven't done so, especially if you're looking for tips, ideas, and other related information that can help you achieve financial freedom, stability, and independence. Thank you for watching, and see you in the next video.